Okay, the reversion to the mean bias. We're all affected by all sorts of bias in our trading and investing. The ones that are really well known are the confirmation bias and recency bias. But I think one of the most dangerous you can be affected by is the reversion to the mean bias, because it leads you astray in so many different ways. So that's really something you want to be able to identify in yourself if you're affected by that, and try to work on it. And the reason is this bias pushes you to constantly try to buy the weakest stocks in the market and try to short the strongest stocks in the market. You're constantly trying to pick tops and bottom. You're like always trying to short stocks that are going like this, and you're always trying to buy stocks that are going like this. When you hear people talking about stocks, you often hear things like, it's down so much, it's got to bounce. You know, it's down so much, it's got to bounce. Or trees don't grow up to the sky. So I want to take a minute to talk about price formation. Often people seem to talk about stock price like they're moved by this like invisible gravity-like force over here when they're going down, or over here when they're going up. But stock prices don't move. Stock prices are being moved. The people that are putting in order on this side and people that are putting in order on this side are moving the price of this stocks. They're moving this price. There's no gravity-like force or laws of physics that take price up and down every day. So, and this is something you really have to think about when you're trading, is that what is going on here? Why is this price doing this? Or why is this price doing this? Rather than just see it as something that's moving on its own. And often I often hear people talking about stock prices move in like their own animal, and that they're moving on their own. When you're trading, I think it's very important to accept the fact that there is a rationale behind the stock move. You may disagree with that rationale, or you might think that it's irrational, but there is a reason for people to act the way they do. So people that are selling their stock here and then down here, and then they're still selling it down here, they think they're getting the best price for this stock. They think that's the best price they're going to get, otherwise they wouldn't be selling it. And the fact that this stock is already down this much, they still think this is the best price they're going to get. And really you have to think about that, and not just think about this stock has already traveled this far, or this stock is going down, it has to bounce at some point. And again, you may disagree with the rationale, you may talk about high frequency trading and algorithm, but again, I just want to take a minute on that. Algorithms are used by humans to execute trades in a more efficient way. Or sometimes they're used by high frequency trading computers to also execute trades in a more efficient way. But being humans, or being high frequency trading strategies, there is a rationale for why they are selling that stock and for why the price is moving the way it's moving. And this is something you have to be cognizant of all the time in the market, rather than just look at price as this thing that sort of moves up and down between these two polar opposites, like there's this magnetic force that's moving the stock price. And really the market is the ultimate crowdsourcing mechanism of opinions and the pricing of opinions. So you have all these people that are of the opinion that the price of this stock is going down, and it's going to keep going down, and that's why they incentivize to sell the stock at this price, and then keep selling it down there. So for you to come in here and say, okay, I think this is wrong, and these people shouldn't be selling this stock at this price, I'm going to come in and buy it. So basically you making a judgment call against all the other people. So sometimes you're going to be right, and the stock is going to bottom at some point and turn around, but a lot of the time you're going to be wrong against the crowd. It's basically it's a numbers game. It's a odds or math game that often the crowd is going to be right and you're going to be wrong. And the truth is, stocks that start the day trending in one direction, often they keep trending in that direction for the entire day. Very few will completely reverse course during the day. So there's going to be a lot of volatility inside that move probably, but it's pretty rare that a stock completely does a 360 and turns around. So when you're deciding to go against that trend, again, you're kind of stacking the odds against you. So again, I strongly believe that the odds of winning in trading or in investing are much higher when you go with the trend than when you're trying to go against the trend. And the thing with the reversion to the mean bias is that it pushes you to constantly try to fade the trend, because you think that this is up so much, it has to go down, or this is down so much, it has to go up. And I don't believe that's true. It's true that there are a few instruments in the market that are mean reverting by nature, like the VIX, but there's just very few of them. And I don't think stocks are among things that are mean reverting in nature. And the thing is, we've been brainwashed by the retail marketing industry to always look for the discount, you know, the 50% off sale. And it sort of pushes a lot of people to do the same thing in the market. But you have to realize something, is that down a lot, it doesn't equal cheap, or up a lot doesn't equal expensive. Like if you take example from this past year, people that have been trying to buy oil, hoping for a reversion to the mean trade, well, basically they've lost all their money, or they're even out of business. And or people, to take an example from the same sector, people that have been buying Hero, you can check the chart, Hercule Offshore, that stock is down 90% this year. I mean, it's an oil-related stock, so it was down with oil. And just last week, it was given a price target of $0 by Deutsche Bank. So yeah, some stocks do go to zero. So people that have been trying to pick the bottom on this stock, well, they basically lost all their money. Or people have been trying to like fade the move in some stock like PCYC. It's up I think it's up like 3,500% in the past 5 years. Well, if you've been trying to pick the top in that stock and wait for the reversion to the mean, well, it's the same thing. You've lost all your money. So again, this idea of if it's down a lot, there must be an opportunity to go long, or if it's up a lot, there has to be an opportunity to go short. Well, this is something that you really have to reconsider if it's something that you're constantly chasing. So again, there's no laws of physics or laws of probabilities that says that a stock has to retrace a strong move. Often it will, but also often it won't retrace that move. And you can also look up something called gambler's fallacy that kind of touches on the same point. I truly think this is the worst bias, because it really draws you into repetitively chase poor or low probabilities opportunities, and that's really something you want to avoid. I mean, you don't always trying to short the stronger stock or always trying to buy the weaker stock is not something you want to keep doing all the time. So you have to really try to change your mindset and really think about what is moving price. Why is price moving the way it is? I think you really, when you're about to enter a trade or make an investment, you really want to think about what is the person that is on the other side of that trade thinking. Why are they thinking that this is the best time for them to exit that trade when I want to enter? And if it's a computer that's executing a high frequency trading strategy, you also want to be able to understand what is that trade? Why is it doing this now? And really you want to be able to evaluate, is this a good time for me to enter that trade given what the other people that are on the other side of the trade thinking. And I mean, kind of in, like they say in poker, the cards that your opponents are holding in their hands are a lot more important than the cards that you're holding in your hand. I mean, this is something that I'm constantly thinking about when I'm about to enter a trade, is what are the people on the other side of that trade thinking? What is their rationale for acting the way they act? And I think that's something that you really want to think about. And if you think you're affected by this reversion to the mean bias, and I think you really want to change your approach of what you think is going on in the market and why it's going on, and what are the forces that are at play, and what comes into the formation of price. So I think maybe later I'll do a full video just on price formation, because there's a lot to say there. But really, again, if you think you're affected by this bias, I think you really want to work on this and get rid of the reversion to the mean bias, because it's going to lead you, again, always to be chasing low probability trades in trying to fade strong stocks or buy the weaker stocks. So get rid of the reversion to the mean bias.